Good day, everyone, and welcome back to another episode of the Aussie Property Blueprint. It usually starts with a flyer or an email subject line that screams, invest in a CBD capital city property for under $300,000, or maybe guaranteed 6% rental return for 5 years. Hands-off investment. Sounds incredible, right? In a market where a decent house in Sydney or Melbourne costs an arm and a leg, the idea of buying a prime city apartment for the price of a luxury car is seductive. You get the title deed, a hotel chain manages it, and the checks just roll in. But as we always say on this show, if it sounds too good to be true, you need to start digging. Today, we are doing a deep dive into serviced apartments and hotel-style strata units. Are they the ultimate cash flow hack, or are they a capital growth graveyard? We're going to break down how the guaranteed return actually works, why banks hate lending against them, and the one specific type of investor who might actually benefit from them. Grab a coffee, settle in. Let's get into it. First off, let's define what we are talking about. We aren't talking about a standard apartment you buy in Bondi or South Yarra and rent out to a tenant on a 12-month lease. We are talking about serviced apartments or hotel strata units. Think about big names like Meriton, Quest, or Adina. Often, these buildings operate as hotels. Short-stay guests check in, they get room service, housekeeping, the works. But the building itself isn't owned by one giant corporation. Instead, it's strata titled. That means individual investors, people like you and me, can buy individual rooms or suites within that hotel. Why does a massive hotel chain want to sell you a room? Why not keep the profits? Well, it comes down to a strategy called capital recycling, or moving to an asset-light model. Building a hotel is a heavy game. It costs hundreds of millions to buy the land and build the tower. By strata titling the rooms and selling them to individual investors, the developer gets their capital back immediately. They sell the unit to you, but they keep the management rights. They transition from being a property owner to a service provider. They take your money to pay off their construction debt or fund their next project, and they just skim a management fee off the top of your rental income. So, on paper, it looks like a win-win. You get a cheaper entry point, sometimes as low as $200,000 or $300,000, and they get to scale their business without tying up their own cash. But here is where the glossy brochure meets reality. The biggest selling point for these units is the guaranteed rental return. You will often see bold claims, 6% return guaranteed for 2 years, or 5% net return for 5 years. For a novice investor, this feels safe. It feels like a bond or a term deposit, but with property attached. But we need to unpack what this guarantee actually is. First, you have to ask, is this rental income coming from the actual market performance of the hotel, or is it a subsidy? Here is a common trick in the industry. Let's say the property is worth $300,000 based on comparable sales. The developer might list it for $330,000. That extra $30,000? They essentially drip feed that back to you over 3 years and call it a rental guarantee. You are often funding your own guaranteed return through an inflated purchase price. Secondly, the guarantee is only as strong as the entity providing it. As we saw in the source material for today's episode, you aren't investing in residential housing. You are investing in the tourism and hospitality industry. What happens when there is a pandemic? What happens if there is a pilot strike? What happens if the corporate travel budget gets slashed because of a recession? If the hotel operator goes bust, that paper guarantee is worthless. We saw this during COVID-19. Many guaranteed returns evaporated because the contract had force majeure clauses, basically acts of God clauses that allow them to stop paying if something major happens. And then there is the cliff edge. Let's say you get your 6% for 2 years. Fantastic. What happens in year 3? Once the guarantee expires, you revert to the market rate. If the hotel is struggling to fill rooms, your income could drop by half overnight. Or worse, the operator might prioritize filling their own units before filling yours. So, that set and forget income, it's usually only set for a very short time. Now, let's talk about the 2 things that usually kill this investment for serious wealth builders: finance and liquidity. If you walk into a Big Four bank in Australia and say, I want to buy a 40 square meter serviced apartment in the CBD, watch the loan officer's face. Banks generally dislike these assets. Why? Because they are small, often under 50 square meters, and their usage is restricted. You can't just kick out the hotel operator and move in yourself easily. Because of this, banks often won't lend you the standard 80% or 90%. They might cap you at 60% or 70% LVR, loan-to-value ratio. That means you need a much bigger deposit. And often, you'll be paying a higher interest rate because it's classified closer to a commercial loan than a residential home loan. This kills your leverage. And in property, leverage is how you build wealth. But the biggest nightmare is exit strategy. Let's fast forward 10 years. You want to sell. Who are you going to sell to? When you sell a normal house in the suburbs, you have a massive pool of buyers. First home buyers, families, upgraders, and investors. That emotional demand drives prices up. But with a serviced apartment, you can't live in it permanently, usually. You can't renovate it to add value because it has to match the hotel standard. So, your only buyer is another investor. And investors are ruthless. They make decisions based purely on numbers. If the yield isn't high enough, they won't buy. This limits your capital growth severely. While the residential market might double in 10 to 15 years, we often see serviced apartments selling for the exact same price, or even less, than what they were bought for a decade ago. You might have made some cash flow along the way, but you missed out on the massive growth engine that is Australian land value. Okay, I've been pretty harsh. Is there anyone who should buy these? The short answer is yes, but it's a very specific niche. If you're in the wealth accumulation phase, if you're trying to build a portfolio to retire on, this is generally a bad idea. It ties up your borrowing capacity for very little growth. However, let's say you are a high net worth individual. You already have a massive portfolio of high growth houses. You are cash rich, and you are looking for a place to park cash specifically for yield and maybe for some lifestyle perks. Some of these investments come with owner benefits. For example, the hotel might allow you to stay in your unit or a similar one for 2 weeks a year for free or at a deep discount. If you love holidaying in the Gold Coast or Port Douglas, and you would spend $10,000 a year on hotels anyway, buying a unit there might make sense as a lifestyle purchase that pays for itself. But, and this is a big but, you need to check the tax rules with your accountant. If you use the property yourself, you generally cannot claim tax deductions for that period, and the ATO is watching this area very closely. So, if you view it as a holiday home that washes its own face rather than a high-performance investment vehicle, you might not be disappointed. But for 95% of investors, there are better places for your money. So let's bring it all home. The allure of the serviced apartment is the low price point and the promise of hassle-free income. It's the lazy investment. But in property, lazy usually means low performance. If you're in the early stages of your journey, stage 1 or stage 2 of wealth building, you need growth. You need assets that appreciate so you can leverage that equity to buy the next one. Serviced apartments generally do not do that. You are handing over control to a management company. You have no say in the furniture, the rent, or the usage. You are a passenger, not a driver. My advice: if you have $300,000 or $400,000 to invest, don't be seduced by the shiny hotel lobby. Look at standard residential units in boutique blocks, or save a bit more for a townhouse in a growth corridor. Look for something with land content, owner-occupier appeal, and financing flexibility. Always ask yourself, is this the absolute best use of my borrowing capacity? If the answer is, I'm just buying it because it's cheap and easy, walk away. That's it for today's episode. If you enjoyed this deep dive, please leave us a review and share this with that friend who keeps talking about buying a hotel room. This is the Aussie Property Blueprint, and I'll catch you in the next one.